What is a credit card? A credit card is a financial tool that allows users to borrow money from a bank or financial institution to make purchases. Unlike debit cards that draw directly from your existing funds, credit cards provide a line of credit that must be repaid later. Credit cards typically come in plastic or metal form with several key components. These features allow for various types of transactions, including in-person, online, and phone purchases. When you make a purchase with a credit card, you're actually borrowing money from the card issuer, which you'll need to repay later. In summary, a credit card is essentially a convenient borrowing tool that offers flexibility and purchasing power. Let's see exactly how a credit card transaction works. When you make a purchase with your credit card, four main parties are involved. You as the cardholder, the merchant where you're shopping, the card network, like Visa or MasterCard, and your card issuer, which is typically your bank. The transaction process involves several steps that happen within seconds. First, you swipe, insert, or tap your credit card at the merchant's payment terminal. Next, the merchant's terminal sends your card information and purchase amount to the card network. The card network then forwards this request to your card issuer for approval. The card issuer verifies that you have sufficient available credit for the purchase and checks for fraud. If everything is in order, they authorize the transaction and place a hold on that amount of your credit line. The approval is sent back through the card network to the merchant, who completes your purchase. Finally, the transaction amount is added to your card balance, and you'll see it on your next statement. This entire process typically takes just seconds to complete. Remember that while authorization happens instantly, the actual settlement between the merchant and your card issuer usually happens at the end of the business day in a batch process. Credit cards operate on billing cycles, which are typically periods of 28 to 31 days. During each billing cycle, all your transactions, payments, and fees are recorded. At the end of each billing cycle, the credit card issuer generates a statement. The statement shows all your transactions, previous balance, new charges, payments made, and any fees applied. It also displays your new balance, minimum payment due, and payment due date. The payment due date typically falls 21 to 25 days after the statement closing date. This period between your statement date and due date is often called the grace period. Most credit card issuers offer convenient online access to your statements and transaction history. This allows you to view current and past statements, download transaction history, set up payment reminders, and make payments online. When you use a credit card, you're required to make at least a minimum payment each month. This minimum payment is typically calculated as 1 to 3% of your outstanding balance, or a fixed amount, like $25 to $35, whichever is greater. While making only minimum payments keeps your account in good standing, it has significant downsides. First, it dramatically extends your debt repayment period, often taking many years to clear even modest balances. Second, it substantially increases the total interest you'll pay over time. Let's look at a concrete example. Consider a credit card balance of $3,000 with an annual percentage rate of 18%. If you make only minimum payments, typically about 2% of the balance, it would take over 10 years to pay off this debt. And you would end up paying nearly $4,000 in interest alone, more than the original balance. In contrast, by making larger payments of $150 each month, you could pay off the same debt in just 2 years, and you would only pay about $570 in interest, a savings of over $3,400. The key takeaway: while minimum payments might seem convenient, paying more than the minimum, even slightly more, can save you years of payments and thousands of dollars in interest. Credit cards come with various fees and penalties that can significantly impact the total cost of using them. Annual fees are yearly charges for card membership, ranging from $0 for basic cards to over $550 for premium cards with extensive benefits. Late payment fees are charged when you don't make at least the minimum payment by the due date. These typically range from $25 to $40. Over-limit fees can be charged when you exceed your credit limit, though you must opt in to allow transactions that exceed your limit. These fees can be up to $35. Balance transfer fees are applied when you move debt from one card to another. This usually costs between 3 to 5% of the transferred amount. Cash advance fees are charged when you use your credit card to withdraw cash. These fees are typically 5% of the amount withdrawn or a minimum of $10, whichever is greater. Foreign transaction fees apply to purchases made outside your home country or in foreign currencies. These typically range from 0 to 3% of the purchase amount. One of the most significant penalties is the penalty APR, which is a higher interest rate applied when you miss payments. While standard APRs typically range from 16 to 24%, penalty APRs can go up to 29.99%, significantly increasing your cost of borrowing. This can have a significant impact. For example, on a $1,000 balance, standard interest might cost around $20 per month, while a penalty APR could increase this to about $30 per month. Over a year, that's an additional $120 just because of missed payments, and penalty APRs can last for 6 months or longer. To avoid these fees, pay on time by setting up autopay, stay under your credit limit, choose cards with no annual fees when possible, look for cards without foreign transaction fees if you travel, and avoid cash advances. Many credit cards offer rewards programs where you can earn points, miles, or cash back on your purchases. These reward programs typically offer between 1 and 5% back on your spending, depending on the card and purchase category. Many cards offer higher rewards for specific spending categories. For example, you might earn 5% on groceries, 3% on dining, and 2% on travel and gas, with 1% on all other purchases. Your rewards can be redeemed in various ways, including travel bookings, statement credits, gift cards, merchandise, or simply as cash back. The value you get from your rewards can vary depending on how you redeem them. Travel redemptions often provide the best value, especially with premium travel cards. Beyond rewards, credit cards often offer additional valuable benefits. These can include purchase protection, extended warranties on items you buy, travel insurance, and rental car coverage. Premium cards may also provide airport lounge access and concierge services to help with restaurant reservations, travel planning, and more. There's typically a relationship between a card's benefits and its annual fee. Standard cards offer basic rewards of 1 to 2% and essential benefits, with annual fees ranging from $0 to $95. Premium cards offer higher rewards rates of 2 to 5% or more, along with premium benefits like airport lounge access and concierge services, but charge higher annual fees from $95 to $695 or more. When choosing a credit card, it's important to consider whether the rewards and benefits you'll actually use outweigh any annual fee you'll pay. Credit cards can significantly impact your credit score, which affects your financial opportunities. Your credit score is determined by 5 key components. Payment history makes up 35% of your score, while amounts owed accounts for 30%. The length of your credit history contributes 15%, with new credit and credit mix each adding 10%. Several positive credit card behaviors can boost your credit score. Making on-time payments consistently shows reliability to lenders. Keeping your credit utilization below 30% demonstrates responsible borrowing. Maintaining long-standing accounts establishes a solid credit history. And having a diverse mix of credit types shows you can manage various financial obligations. Several behaviors can damage your credit score. Late or missed payments have an immediate negative impact. High credit utilization above 30% suggests financial strain. Applying for multiple cards in a short time creates numerous hard inquiries, and closing old accounts shortens your credit history and reduces available credit. Credit utilization is one of the most important factors in your credit score. It measures how much of your available credit you're using. For the best impact on your score, keep your utilization below 30%. For example, If your credit limit is $10,000 and your balance is $2,500, your utilization is 25%, which is good for your credit score. Responsible credit card use can help you build an excellent credit score over time. This opens doors to better financial opportunities, including lower interest rates, higher approval odds for premium cards, better insurance rates, easier approval for housing, and more negotiating power with lenders.